Hello everyone, this is the part 2 of the moving average chapter. So we had done the chapter till here, moving on. So now we come to a very interesting concept, which is the directional movement. Here we are going to even study some of the new indicators which were made using the concept of moving average included in it. So just a second, let me fix my mic. Okay, so directional movement basically speaks about the movement of the commodity or the stock in a particular direction. So that these indicators basically show us and help us with the direction of the trend. Okay, so now we need to keep some of the concepts in mind. It looks really technical in nature and it looks like it is difficult, but it actually isn't. So this was developed by Wells Wilder. We are going to read a lot about Wells Wilder because Wells Wilder is the person who has given the maximum contributions to the technical analysis. So there are two types of directional movement. There can be three types of directions, right? Either the price can go up, or the price can go down, or the price can be in the same range. For now, let's just consider the upward movement and the downward movement. What do you think the meaning of positive direction movement will be? Positive directional movement will just mean that today the price was more than yesterday. Very simple. So positive directional movement is when the high of the day exceeded the high of the previous day. If today's high is more than yesterday's high, that is a positive direction movement. Okay, so that is DM plus DM, positive direction movement. So how do you hello? Yeah. So how do you basically find the positive direction movement? Day's high minus the previous day's high, or the vertical distance between the tops. By tops, they mean that is the highs. Just a second, I'm trying to fix my mic. Yeah. So that. Now, what is the negative direction movement? It's just the opposite of the positive direction movement. So it's when today's low is lower than yesterday's low, that would be the negative direction movement. So that is the difference between two lows. So sometimes you know that the range of today can be the same as the previous day, where there is high, low, both are inside yesterday's high and low. In those days, what we are going to do, one day's trading range is sometimes larger than the previous day's trading range. That is also possible. So we can have two candles. Like we can have something like this. Yesterday's candle was this. Today's candle was like this. So my high and low are both inside yesterday's candle. We can also have something like this is yesterday's candle. Today's candle is like this. The high and low both are more than yesterday's. So in situations like that, how are we going to calculate the direction movement? Because direction has taken place in no direction or in both directions, right? So in situations like that, you are going to consider which one is the highest. Let's say this is a candle. The low also exceeded, but the high also exceeded. So is the high, so we can see that the low is also lower than yesterday's low, and the high is also higher than the previous high. But which one is more in proportion? We can see that the high is more as compared to the low. So in that case, we will only consider the positive direction movement. And if the low was lower in proportion more than that of high, then we would consider it as negative directional movement. Simple stuff. Absolutely nothing is difficult. Plus DM is when high of today is higher than yesterday's high. Minus DM is when low of today is lower than yesterday. And in situations when both of them are equal, in situations when the high and low both are different, or both are higher and lower than yesterday, in situations like that, the DM which we would be considering would be which has the more change in proportion. Okay. Now let's talk about the indicators which are basically using this concept which we have just discussed. So this is the DM, direction movement by Wilder. Now look at this. This is yesterday's candle. Today's candle broke the low and the low is lower. That's why minus DM. Here this was yesterday's high. High was broken and a newer high was created. So this is plus DM. Here we can see that this candle's high and low is inside yesterday's high and low. In situations like this, there is no DM, and here high and low both are the different, both are higher and lower, then whichever is larger that we would be considering. This is what is my DM. directional movement. Very simple. And you need to keep in mind that most of the time these indicators use a 14 period range, that is a 14 days range. Okay, so they usually use Wilder method of averaging. So 14 day. So what is Wilder method of averaging? So Wilder has his own moving average, okay, which uses basically 14 days of period, and this moving average is of Wilder itself. So what's special about his moving average? His moving average is calculated based on the plus DM and the minus DM, and the period which is taken into account is 14 days. And this is what is known as Wilder's moving average. You might get an MCQ on this. And 14-day average trading range is calculated. We know what ATR is, average trading range. We have done that in the previous level. So ATR is calculated. After that, first a moving average is calculated by the plus DM and the minus DM, and then an ATR is calculated. And then what they do is the positive direction movement indicator, which is DI. What is positive direction movement indicator? DI, that is ratio between the smoothed plus DM and the TR. DM, we know what DM is and we know how to calculate the DM. So when you take the ratio between the plus directional movement and the ATR, then we get the plus DI. And how do we get the negative? Same way, minus DM ratio with the ATR will give you minus the DI. And this is going to be for 14 days. Keep that in mind. The period is 14, and the plus DM and the minus DM, whatever we are going to calculate, it will be in smoothed nature. That's it. We are done with this Wilder. Very simple. Nothing to worry about it. If you know the concept of it, then you will be doing well in the exam. If you want, you can go on TradingView and just check out the indicator for sure. Now, how do you exactly use these direction movements? Let's talk about that. So if you look at this particular chart, they have given us a chart of Walmart, and this is how the Walmart is going up. And you can see that below you can see the DIs are basically marked. We know what DI is. DI, do you want me to revise? Okay, I'll just do it. DI is plus DM, which is smoothed, and ratio with the average true range of the 14-day period. And what is DI minus? Minus direction movement with the ratio of ATR. Now both of them are plotted over here. You can see that this one is DI minus, which shows the negative effect, and this above line shows us the positive one. Keep that in mind. And there are places like XI, like X2, where they are basically crossing over each other. Now how are we going to use this as a particular methodology to trade? Now, if my plus directional movement indicator crosses my okay, let me just show it to you by underlining it. Okay, look at this. Do we see that this particular line is of the minus DI, and we can see this is of the plus DI. The red one is the plus DI. Okay, so the plus DI crossed my minus DI from the down, right? The plus crossed the minus one, then here we could have entered because there was a cross, and look at how the price went up. Moving on, we can see that the plus, this is my plus DI, right? And then we can also see here again they crossed. So here what happened? You could have sold over here and it would have gone down, right? This is when the minus crossed the plus, and here was when the plus crossed the minus. So when the plus DI crosses minus DI, then we can basically take an upside trade. When the minus DI crosses the plus DI, we can take a downside trade. But again, this should not be the sole basis on which you are taking a trade. You need to make sure to confirm it with something else. Now let's also see some more things where DI can be used. So this was the indicator which we just saw. And DI can also be used to create a directional index. Now what exactly is directional index? You must have heard about an indicator which is the ADX. So let me just show it to you quickly. Average directional index. So this is how an ADX line looks like, and it's usually of, look at this. It is automatically set to be of a 14 period. That is why we are saying that we need to use certain indicators with the specified period which they are given. However, you are free to always change the period according to your convenience. But then Wilder had suggested that we should be using a 14 period. Now, why is that so? You can look that up on the net. I'm pretty sure there is some particular Fibonacci or a technical reason because of which a 14 period works the best. Again, the all the indicators which we are using, we are always free to change them however we want to. One thing I'd like to emphasize on over and over again is that whenever you are using an indicator, we need to make sure that you are not only using just one indicator, but you are supposed to confirm it with additional indicators. Like the one example which we saw, what did the person do? The person basically used a trend line and confirmed the trend line along with the indicator. So that's how you are supposed to confirm your trades. Like for example, I use volume as well in my trading, right? So there should be some specialist feature which you are going to be using in your particular trading. Now ADX. ADX is basically standing for average directional index. This is again showing us the direction of the trend. Here also again you need to keep in mind that DIs are used, okay? And the DX is calculated by taking the absolute difference between the values of the two DIs and dividing it by the sum of two DIs. We got two DIs plus DI minus DI. You're going to subtract them and you're going to divide it by the sum of the DIs. So subtracting the DIs and dividing it by the sum of the DIs, this is going to give you the DX line. And what is ADX? ADX is basically the smoothed value of the DX, right? So you know how to calculate DX, we just saw that. And when you're going to smooth the DX, you are going to get the ADX. When the ADX is rising, the market is increasingly trending in either direction. So usually what people say is that when the ADX is above 20, that means that the market is trending in nature. When the ADX is below 20, then the market is not trending in nature. By trending, I don't mean just towards the upside. The trending can be towards the upside or the downside. So let's just take an example of, let's say, this particular rally. Now let's see the ADX there, corresponding it. We can see that the AD from here, the rally started from here. Look at this. Earlier on, the if you can see that here, okay, let's see, the ADX was like around 16, 11, 10, 13, but this then it started to rise 26 and then 30. See, the ADX started rising, so ADX started rising and the price also started rising in nature. So that is what you have to basically keep in mind, that when the ADX is rising, then the market is also trending in a direction. That doesn't mean that it is trending only in the positive side, right? For example, if you look at this from here, there is a short side trade going on, right? So if you look at the ADX, you look at this, it started from here. So look at the ADX over here. What's the ADX? 49.50. So we can see that the trend is strong in the market, and we can see that the price is going up and the ADX was also above 20. The moment the ADX came to, let's say, 8, here is when you can start thinking about the opposite side. So that's how we are going to use the ADX. ADX peaks and troughs also provide valuable information. Now, what do they mean by that? So let's say the price is creating higher highs and higher lows, showing an uptrend, but the ADX is creating lower highs and lower lows. That shows that the strength in the direction is now weak. Strength in the direction is now weak, and because of this bias, because of this dilemma of opposite directions, we can already understand that the price is going to reverse. That's what they are saying. Trough and peaks, you can see that the price trough and peak, so it's going to follow. And then again, the moment they don't coordinate together, you need to know that there might be a reversal in the particular price action. Now we come to the envelopes, channels and bands. These are very simple and I'm pretty sure you know them all. These are basically envelopes. So beginning with envelopes, let's talk about what are bands in general. So these are particular bands which are formed on some particular calculation, and the price tends to oscillate between the bands. Sometimes it might even break the band towards the upside or the downside, and we can take a trade based on that as well. What are percentage envelopes? So by the name itself, we know that percentage envelopes are calculated using certain percentages, right? So percentage envelopes are also known as percentage filters. So keep that in mind. So what was the purpose of the percentage filters or percentage envelopes? So when you talk about the crossover strategies of moving average, which is when, let's say, 30 and 40 moving average are crossing, so now I will buy and stuff like that. When you are trading based on such things, there are a lot of whipsaws and there are a lot of stop loss trades, or there are lots of unsuccessful trade. So these kind of things we want to reduce, because of which we've stopped using the crossover systems and we've started using the envelopes to reduce these kind of whipsaws. Okay, so how do you do that? You basically take the percentage of the moving average and plot it above and below the moving average. You are going to take the percentage of the moving average, right? The moving average which you've plotted, and you are going to create a line above and below the moving average. Okay, and then that's why it is known as an envelope, because it's enveloping the moving average, right? So two symmetrical lines are created above and below. These are known as the envelopes. Now, the percentage is basically chosen by you. You can choose whatever percentage you want to when you are plotting the envelopes. What is the problem with the envelopes? The percentage which is chosen, it's fixed in nature, right? So when the percentage is fixed, then there is a lot of volatility in the market, and that volatility will not be accounted or will not be considered in your trade. So when the volatility is not accounted or not being considered, then in situations like that, then a lot of problems occur, because volatility is one of the very important factors which have to be used in your analysis, right? So the underlying price has a lot of volatility that is not accounted. And also, when you think about sideways trend, the volatility is really low. So even if the volatility is high or low, it's not taking into account, which is a problem. So you can see the particular chart of Walmart. They've created two um, bands around the moving averages: 10-day SMA, 26-day SMA, and 0.5% envelope of the moving averages. Okay, so next what we have is bands. Now what exactly are bands? Now bands are basically envelopes only, but then this basically solves the problem of volatility, because they start taking into account what volatility is. And here they are not fixed in size, but they are calculated to adjust to the price volatility around the moving average. Okay, so we all know what Bollinger Bands are. I'll just show it to you once on the chart. Let me go to GBP USD. Okay, so this is one forex pair, which is the GBP and US dollar. So if I go on Bollinger Bands, we can see that, let me, so this is how my Bollinger Bands really look like. So do you see how most of the time the price is trading inside the Bollinger Bands? Most of the time, right? Sometimes it will go out, but most of the time it is trading inside my Bollinger Band. So that is what we have to keep in mind, that most of the time the price basically trades inside the Bollinger Band. Look at this. Has there ever been a thing where the price has not traded inside the Bollinger Band? It might just go out a little bit, but then it stays most of the time. All right. Yeah. Anyway, so that is Bollinger. So Bollinger Band were basically named after John Bollinger. He basically took into account the problems which we were facing when we were trading using envelopes, that the volatility of the price was not being taken into account. So because of which he's created Bollinger Bands, and now the Bollinger Bands now take volatility into account. Now what exactly are Bollinger Bands and how exactly are they constructed? First, simple average or moving average is calculated, and then the SMA is used. Just a second. Let me make it green. Yeah. So first SMA is used, okay, and then we draw a band. Draw bands a certain number of standard deviations above and below. First, you take a SMA, and the moving average can be of your particular um, whatever moving average you're using. For example, right now, if you look at the indicator, we have 20 moving average, right? So 20 moving average, and the standard deviations above and below is plotted, and that is basically my moving average. So usually it begins with 20 moving average. Two standard deviations are added and subtracted. Keep that in mind. Standard deviations are added and subtracted above and below. That gives me my Bollinger Band. Okay, now let's come to Keltner Band. Now Keltner Band is again another band which is used. Now, what exactly does that do? Basically, the Keltner band works the best when you are trading commodities like gold, crude oil, natural gas, silver, right? So, whenever you are trading commodities, then the Keltner bands work the best. How do you calculate that? You're first going to calculate the typical price. So, whenever we talk about the typical price, you need to keep in mind that it is close plus high plus low divided by 3. Closing price is very important. Okay, close plus high plus low divided by 3. This is my typical price. After that, you are going to calculate a 10-day SMA simple moving average, a 10-day simple moving average of the typical price. Okay, after that, what are you going to do? You are going to calculate the band size by creating a 10-day SMA of high minus low, or the range. High minus low is just the range, right? That. And then the upper band is plotted as the 10-day SMA of the typical price plus the 10-day SMA of the bar range. Okay, so the typical bar SMA and the bar range SMA. So using them, you are basically calculating, and this is what is known as my Keltner band. Keep that in mind. The typical price is being, the range in the typical price is used in the Keltner band. In the Bollinger band, it's the standard deviations. You need to keep certain things in mind, and when you read over and over again, and when you go and backtest, then you will be able to remember all of them. Okay. Next, we have the Stark band. Stark band is basically Stoller average range channel. Okay, so that basically uses ATR, which is the average true range, over 5 periods added to and subtracted from 5 period SMA. So you have a 5 period SMA and you have a ATR of 5 periods and you add and subtract to it. That is my Stark band. Okay. Moving on to starting with the how do you basically use these particular bands to take a trade. So you need to keep in mind that if, let's just take an example, if I enter over here, exit over here, enter over here, exit over here, I can do that and I can make a profit out of it. But what do we need to keep in mind? That can't be the only sole reason why we are taking a trade. We need to also see the overall direction of the market. Like right now, I know that the market is in this phase. I know that the market is in a downtrend. So I will short over here, right? And book over here. Again, the price came here. I will short over here. And again, I will book over here. I'll short over here. I'll book over here. So again, I'll short over here. And I won't be able to book over here. Why? Because my SL will be hit, because now the direction has been changed. So you can make your own particular trading strategy using the bands, right? So that. And you can also use various bandwidth indicators. So what is bandwidth indicators? Bandwidth indicator is basically the difference between the high band and the low band, and then you are going to plot it. When you take the difference between the high band and the low band, that is basically going to show you the price volatility. Okay, next we come to the Donchian channel. So what exactly is Donchian channel? Let me just show it to you on the chart itself. See, these are basically a very famous indicator. Let me remove the BB and volume as well. Yeah, this is the Donchian channel. So this is how a Donchian channel looks, and you can basically set the length whatever you want to. Now, what exactly is a Donchian channel and how is it calculated? So we already saw what a normal channel is, that when the price is, let's say, moving like this and I make a box like this, that is a channel or a range. So that is what a general definition is, right? So channels have been described as something simpler than two parallel lines. For example, we mentioned the Donchian channel method. Now, what exactly is Donchian channel method? Signals occur when the Donchian channel, when the breaking above or below a high or low over some period occurs. Now, what does that mean? High or low of some particular period occurs. For example, if you look at this 20-day high and a 20-day low. So when 20-day high is broken, there will be a signal. When 20-day low is broken, there will be a signal. So that is what is my Donchian channel. So let's take an example of how you are going to trade when you look at the chart. It's not loading. Anyway, I'll just show it to you through the example then. So Donchian channel is basically taken using a period of 4 weeks or 20 days. Okay, so 20 days. So whenever your price exceeds the high of the previous 4 weeks, you're supposed to buy. Whenever the price exceeds the low of the previous 4 weeks, then you are going to sell. That is how the Donchian channel is basically used. So that's it with this chapter. We are done with this chapter. This was a considerably lengthy but simple chapter. So that's it about moving averages. Now, you all, I have a task for you guys. Go on TradingView, go on investing.com, and just try to backtest all the bands, backtest all the moving averages, and see how to basically use them. Because if you won't be doing the practical things, then you might not be able to remember half of the things. And the aim of me basically teaching CMT is not just because I want you guys to clear the exam. That, yeah, of course, I really want that everybody clears the exam, but at the same time, I also do want that you guys become a better trader. Thank you. In the next, we will start with the trend systems.